The financial world, in its current state of heightened, instantaneous communication and market access, often confuses price with value. This is the first and perhaps most devastating error a modern participant can make. Augustin Lebrun, in establishing the very first law of trading, anchors the entire discipline in an unshakable understanding of value, not simply what the ticker tape is screaming at any given moment. He argues that every trade, every investment, must be rooted in an objective, reasoned assessment of what an asset is fundamentally worth, a value that is inherently independent of market noise, social media hype, or the emotional cascade of recent price action. This principle forces us to stop watching the crowds and start analyzing the bedrock upon which all successful enterprises and reliable assets are built. If we are buying something, we must be able to articulate precisely why that asset should be worth more in the future than it is today, using metrics and logic that transcend the narrative of the moment. The principle of value, as Lebrun explains it, is the necessary discipline of calculating the true economic engine beneath the hood of any stock, bond, or even digital asset. It demands a rigorous, almost academic detachment from the speculative frenzy that defines a contemporary market. For a stock, this means looking far beyond the latest quarterly earnings press release and diving deep into the cash flow statements, the debt structure, the competitive moat the company possesses, and the long-term viability of its business model. It requires asking tough questions. Is a company truly profitable, or is it merely subsidized by endless round of venture capital funding? Does it possess a unique intellectual property, or is its product easily replicable by the next competitor? The vast majority of retail trading today is divorced from this process, substituting due diligence for collective enthusiasm. People buy because the price is going up, which is a circular and inherently fragile rationale for holding any asset. Lebrun's framework compels us to flip this script. The price is merely a reflection of current sentiment. Value is the only reliable guide to future returns. The true intellectual challenge Lebrun presents here is a requirement for independent thought in a highly networked world. Value assessment is inherently a lonely endeavor. It requires the trader to develop a proprietary, well-researched perspective that often contradicts the prevailing narrative echoed by financial influencers and mainstream financial media. When a stock is cheap, the narrative is usually negative. The company may be facing litigation, management changes, or a temporary downturn. The crowd avoids it, paralyzed by fear. The value trader, however, sees the opportunity only when this confluence of bad news and low price creates a demonstrable margin of safety, the difference between the asset's calculated intrinsic value and its current trading price. This margin of safety acts as a buffer against unforeseen events and is the primary mechanism for generating superior returns without taking excessive risk. When the price begins to surge, driven by FOMO culture, that margin of safety evaporates, and the value trader must recognize that the asset has moved from the realm of investment back into pure speculation. This concept becomes profoundly illuminating when viewed through the lens of recent market history, especially the spectacular rise and fall of various meme stocks. We witnessed a powerful, undeniable cultural moment where the price of certain stocks became wholly detached from their fundamental value. A video game retailer or a cinema chain, facing secular declines in their core business, suddenly saw their shares moonshot based purely on the coordinated effort and collective conviction of online retail communities. For a trader operating under Lebrun's principle of value, this situation presents a clear, albeit challenging, decision. While acknowledging the social media financial panic cycles and the powerful force of narrative-driven momentum, the principle dictates that the trader cannot justify a long-term hold, or even an aggressive buy, simply because the momentum is favorable. The actual intrinsic value of the businesses did not multiply 10 or 20 times overnight. Lebrun would view this as a classic example of leverage addiction manifesting as a cultural phenomenon, where the true trade being made is not on the company's future earnings, but on the continuation of the collective delusion. A disciplined trader might play the volatility for a short-term, highly risk-managed trade, but they would never confuse that speculative maneuver with a value-based investment. The eventual, inevitable collapse back toward fundamental reality for many of these assets serves as a brutal, expensive vindication of Lebrun's first law. The principle of value is equally indispensable in navigating the volatile landscape of Bitcoin bubbles and the broader crypto market. For years, the valuation of many digital assets has been driven almost entirely by the narrative of disruptive technology, scarcity, and a utopian vision of decentralized finance, often without any corresponding revenue stream, tangible asset, or clear use case. When a project skyrockets solely based on a tweet from a prominent personality or a frenzy of speculative buying, the FOMO culture reaches its zenith. LeBron's law forces a trader to ask, what is the real-world utility? What economic activity is this asset truly facilitating? Is the current price justified by the network's adoption, transaction volume, or security, or is it simply a reflection of the latest wave of hype? The value principle is a shield against the emotional contagion of the market, insisting that we look for a demonstrable edge, some logical reason why we believe the market is currently undervaluing an asset, rather than just hoping the price keeps rising indefinitely. The price is an opinion. The value is an estimation of fact, and only the latter provides a sustainable basis for long-term profit. Furthermore, this law has profound implications for how we view the dominant force in modern investing, the rise of ETF dominance, and the debate over passive versus active investing. Passive investing, driven by index funds and ETFs, essentially trusts that the market, over the long run, correctly reflects value. But LeBron's principle is a tool for the active mind. It is the core mechanism by which a truly active investor seeks to outperform the market. If everyone is passively buying the index, the opportunity for the disciplined, value-focused trader emerges precisely where the market is mispricing assets. The vast influx of passive money can sometimes inflate the prices of already expensive, highly weighted stocks, creating mispricings in smaller, overlooked companies. A LeBron-esque trader would reject the comfort of simply following the herd and instead actively hunt for securities where the price is trading at a significant, unjustifiable discount to its intrinsic worth, using this fundamental mismatch as their trading edge. This law does not just teach you how to trade. It teaches you how to think like a contrarian, armed with a calculation rather than just a feeling. It is the foundational requirement for building a genuine trading strategy, compelling the individual to define their own reality rather than outsourcing their perception of wealth to the daily swings of the market. The ultimate expression of this principle today is a recognition that, in a world where speed is ubiquitous due to zero-commission trading, the ultimate scarcity is the time and intellectual effort dedicated to true, deep value assessment. The core challenge of applying the principle of value in the 2020s is the blurring of lines between fundamental analysis and narrative-driven momentum. The accessibility of zero-commission trading has created a liquidity flood that allows price to disconnect from value for far longer than traditional wisdom suggests. The modern trader must now treat the principle of value not as a static number, but as an anchor in a volatile sea. When faced with a stock that has achieved high valuation on the back of purely aspirational targets, such as some high-growth technology companies relying on the promise of future market domination rather than current profits, the value principle requires a nuanced application. It dictates that the trader must assign a probabilistic value to those future outcomes, rather than accepting them as guaranteed fact. For instance, consider the enduring popularity of Tesla hype. While many traditional value investors screamed that the stock was wildly overvalued based on traditional automotive metrics, the LeBron-style trader will be forced to acknowledge the value embedded in its technological platform, its energy business potential, and the cult-like loyalty of its brand. The value calculation here is complex, involving future discounted cash flows, but it must be done. The discipline is knowing when enthusiasm has so far outstripped the most optimistic potential value, even accounting for all future growth, that the position becomes purely speculative. This principle is a silent alarm that tells the trader, you are no longer trading the asset, you are trading human emotion. In an age where financial TikTok and YouTube gurus frequently conflate a charismatic speaker with sound investment thesis, the principle of value is the necessary, non-negotiable safeguard that grounds every transaction in rational analysis. The modern application of this law also involves understanding the behavioral value. Sometimes the price of an asset reflects not its current earnings, but its capacity to attract permanent capital, a factor that must be cautiously weighed against traditional metrics. If value is the anchor of successful trading, risk is the current that constantly threatens to pull the vessel off course. And the second law laid down by Augusta LeBron is the absolute mastery of this force. In the modern market, saturated with easy leverage and the instant gratification of option gambling. Risk is often treated as an exciting opportunity for outsized returns, rather than a quantifiable existential threat that must be rigorously managed. LeBron shatters this myth, asserting that the primary job of a successful trader is not to maximize profit, but to meticulously control the downside. Profit, in his framework, is a natural consequence of superior risk management, not a primary goal to be pursued recklessly. This means defining the potential loss before initiating any trade, understanding the precise odds of that loss occurring, and sizing the position so that even a series of inevitable losses cannot critically wound the overall capital base. The principle of risk is fundamentally about understanding probability and exposure. It forces the trader to view every potential outcome through a statistical lens, stripping away the emotional bias of hope or confidence. When a trader buys a stock, they are not just betting on the company's success. They are implicitly betting on the market's inability to price that success correctly. The risk is a potential for the market to prove them wrong, either because the company fails or because market sentiment shifts drastically. LeBron emphasizes the concept of expected value, the probabilistic weighted average of all potential outcomes, as the only rational basis for a trade. If a trade offers a 5-to-1 reward-to-risk ratio, but the probability of success is only 10%, the expected value is negative, and the trade should be rejected, no matter how tempting the potential profit appears. This analytical rigor is a cornerstone of institutional trading and the direct antithesis of the impulsive, all-or-nothing mentality fostered by the accessibility of modern trading platforms. The true difficulty in applying this principle today lies in the insidious availability of cheap leverage through technology. Platforms offering margin loans, easily accessible derivatives, and high-risk instruments like 3x leveraged ETFs have democratized the ability to overbet. This ease of use transforms calculated risk into leverage addiction. When capital is cheap and readily available, the impulse is to use it to amplify returns, ignoring the catastrophic consequence of amplifying losses. LeBron would argue that this is the market offering traders a rope with which to hang themselves. The principle of risk demands that a trader must never be forced out of position due to margin calls or sudden volatility. Your risk exposure must be measured not just by the dollar amount of potential loss, but by the percentage of total capital that loss represents. Professional traders often limit the risk on any single trade to a tiny fraction, perhaps 1 or 2% of their total capital. This is not out of timidity. It is a mathematical imperative that ensures survival across a large number of trades, guaranteeing that they can endure the inevitable losing streaks that are a fundamental part of probabilistic trading. A crucial aspect of LeBron's risk philosophy often missed by novice traders is the difference between drawdown risk and position risk. Position risk is a potential loss on a single trade, meticulously controlled by stop losses and sizing. Drawdown risk is the cumulative damage inflicted by a series of losses on the overall portfolio. LeBron would stress that even with the disciplined use of the 1% rule per trade, a series of 10 consecutive losses results in a 10% drawdown, which then requires a greater than 10% gain just to return to the starting equity. The principle of risk, therefore, necessitates a dynamic approach where risk tolerance is reduced during losing streaks, forcing the trader to take a step back and reassess the strategy. This counterintuitive requirement, to risk less when things are going badly, is a defining characteristic of professional risk management and a direct challenge to the emotional urge of revenge trading that plagues retail accounts, often spurred on by the competitive, boastful nature of online social media financial panic cycles. This law is a critical counterforce to the pervasive FOMO culture that drives rapid, uncalculated decisions. When a meme stock or a crypto hype cycle is rocketing up, the psychological pressure to jump in is immense. The risk manager in the mind is silenced by the fear of missing out on easy money. But the disciplined trader, guided by LeBron's law, immediately calculates the maximum potential loss if the momentum reverses and the trade fails. If that calculated loss exceeds their predetermined small percentage, the trade is rejected regardless of the emotional appeal. This is the difference between speculative gambling and systematic trading. Trading, correctly understood, is the business of taking calculated, small risks for a probabilistic advantage. Gambling is a business of taking large, uncalculated risks based on emotional impulses. The modern market, With its 24/7 news cycle and social media amplification, constantly encourages a latter, making LeBron's emphasis on strict, objective risk sizing the most valuable defense mechanism an individual can possess against self-destruction. The principle of risk teaches us that capital preservation is the only enduring law. For if you lose your capital, you lose your ability to play the game. The rise of financial TikTok and YouTube gurus has complicated the application of the principle of risk by often showcasing only the winners and promoting the narrative of effortless, rapid wealth. This curated reality encourages novices to equate high leverage with high skill. The sheer volume of option gambling facilitated by commission-free apps is a direct challenge to LeBron's second law. Options, particularly speculative calls and puts, offer amplified exposure for a small premium, attracting individuals seeking lottery ticket returns. A disciplined trader must use the principle of risk to rigorously assess the Greeks of an option, how its price reacts to time decay and volatility, and not just its notional leverage. This deeper understanding transforms a complex instrument from a reckless gamble into a calculated tool for expressing a specific, time-bound view on a stock's price, always ensuring that the premium paid is treated as a maximum acceptable loss. Furthermore, the ubiquity of index funds dominating global wealth presents an interesting risk dichotomy. While passive investing is often promoted as the low-risk default, the LeBron-style trader must recognize the systemic risk embedded in this concentration. When everyone owns the same handful of technology giants, the liquidity risk during a major correction becomes profound. The principle of risk, therefore, expands beyond the individual trade to encompass portfolio structure, demanding adequate diversification across asset classes and geographies to protect against a synchronized market downturn. In an era where passive investing has made everyone an owner of the same few highly priced stocks, a deeper application of risk management means actively seeking non-correlated assets or employing hedges, rather than blindly trusting that the market will continue its upward trend indefinitely. The true modern risk is not volatility, but concentration, and LeBron's law demands a constant vigilance against excessive exposure to a single narrative or asset class, even seemingly safe ones. If the first two laws, value and risk, form the defensive structure of trading, the third law, the principle of opportunity, defines the offensive strategy. It is the recognition that even with a clear understanding of value and a strict framework for risk, a trade should only be executed when the odds are overwhelmingly in one's favor, when the market offers a genuine time-sensitive edge. LeBron teaches that patience is not a passive virtue, but an active, aggressive strategy. A professional trader's time is not best spent constantly executing trades, but rather in waiting for the perfect convergence of conditions, the moment when a market error, a catalyst, or a fundamental change creates an undeniable misalignment between price and value, all while fitting comfortably within the defined risk parameters. Trading, in this light, is less like sprinting and more like a sniper waiting patiently for the target to enter the crosshairs. This principle directly combats the modern compulsion to always be in the market. The rise of 24/7 crypto casinos and round-the-clock global trading encourages constant activity, fostering the illusion that if you are not trading, you are losing. LeBron exposes this as a psychological trap. The market is constantly producing noise, small, random, and unprofitable fluctuations, and only occasionally producing signal. The principle of opportunity is the mental filter that separates the two. An opportunity is not merely a stock going up. An opportunity is a demonstrable, quantifiable scenario where the market's current price does not reflect the asset's established value, and there is a high probability catalyst that will force the price and value to converge in the foreseeable future. Without both the mispricing, the value differential, and the catalyst, the trigger for the trade, the execution is merely a hope, not a strategy. The concept of a catalyst is perhaps the most action-oriented part of this principle. LeBron would insist that a value differential, however large, is useless if there is no foreseeable event or trigger that will force the broader market to eventually recognize that value. A stock can trade below its intrinsic value indefinitely if nothing compels the market to reassess its position. The catalyst could be an earnings announcement, a regulatory change, a new product launch, a management overhaul, or the eventual calming of a social media financial panic cycle. The disciplined trader doesn't just find undervalued assets. They find undervalued assets with a ticking clock on their revaluation. This targeted focus is what conserves capital and maximizes a return on time, ensuring that the trader is paid for their patience when the market is finally forced to correct its error. Consider a major technology company whose stock drops 30% in a single day due to a temporary regulatory scare or a non-fundamental political tweet. The principle of value confirms that the 30% drop has created a massive, unsustainable gap between the company's long-term earning power and its current price. The principle of risk dictates how large a position can be taken, managing the remaining volatility. But the principle of opportunity is what pulls the trigger. It demands the trader confirm the temporary nature of the scare and identify the likely time frame for recovery, ensuring the market's overreaction provides enough profit potential to justify the capital commitment and the patience required. This law teaches that capital must be conserved not for the purpose of hoarding, but for the express purpose of being ready to deploy massive size when a true, high-conviction opportunity finally emerges. The greatest profit are often made when the market is in a state of extreme distress or extreme euphoria, moments when mispricing is maximized and capital is needed most. The explosion of data and the development of AI-driven hedge funds and algorithmic trading have made fleeting opportunities even harder for the human trader to capture. Quant strategies are designed to exploit instantaneous mispricings. This might seem to render the individual obsolete, but LeBron's law suggests a pivot rather than surrender. The best opportunities for the human, discretionary trader are now found in areas where algorithms struggle, assessing novel, non-quantifiable information, understanding complex political and social shifts, and predicting behavioral herd movements. For instance, the human trader can analyze how a major shift in public sentiment on social media financial panic cycles will affect a company that relies heavily on consumer perception, a complexity that is often too slow or too nuanced for the fastest algorithms to fully price in instantly. The opportunity, therefore, lies in patience, deep research, and the willingness to take a stand when the crowd is running the other way, betting on a return to rational pricing. The scarcity today is not in information, but in the time and mental bandwidth required to process that information into a high-conviction trade idea, a skill that the principle of opportunity rewards handsomely. In an environment dominated by fractional shares culture and instant access, the urge to sprinkle small amount of money across every trending asset can dilute a trader's focus and capital. The principle of opportunity serves as a necessary restraint on this pervasive, low-conviction trading. It challenges the common practice of dollar-cost averaging DCA into every dip, asking instead, is this dip a true, rare opportunity, a significant mispricing, or just a normal fluctuation? DCA is a valid strategy for the passive investor, but the active trader must hold their cash like dry powder for the moments of maximized edge. This law is also essential for filtering the noise of financial TikTok and YouTube gurus. These platforms constantly advertise micro-opportunities, the latest hot stock or crypto token that's about to explode. LeBron's framework demands that the trader subject every one of these tips to the opportunity test. Where is the value mispricing? What is the specific catalyst? And what is the probabilistic expected return after factoring in the risk? If the gurus are promoting a stock that has already doubled, the opportunity has likely evaporated, and the risk-reward ratio is profoundly skewed against the buyer. The principle of opportunity is the discipline of saying no to 99% of what the market offers, ensuring that when you finally say yes, it is with high conviction, appropriate sizing, and a demonstrable edge that makes the trade statistically worthwhile. It is the law that transforms a hopeful gambler into a disciplined allocator capital. The principle of discipline is the emotional backbone of LeBron's framework, the invisible, ironclad rule that governs the execution of all the other laws. It is the recognition that the market's greatest threat to a trader is not external, not an unexpected news event or a market crash, but internal, the trader's own flawed, fear and greed-driven psychology. Discipline, in LeBron's terms, is the unwavering commitment to a predefined plan, the ruthless exclusion of emotional interference, and a consistent, systematic execution of a strategy, even when it feels deeply uncomfortable. This law elevates trading from a creative art to a repeatable, standardized process. The necessity of discipline is acutely visible in the context of the day trading psychology in the 2020s. with screens open 24/7. The emotional feedback loop is instantaneous, creating a pressure cooker environment where every small fluctuation feels like a personal verdict. A day trader without discipline will inevitably fall prey to two destructive forces: revenge trading, where a losing trade is chased an even larger, less rational bet, and overconfidence, where a series of winning trades leads to an expansion of risk beyond the defined limits. Discipline is the stop-loss order placed the moment a trade is executed, not when the pain of loss becomes unbearable. It is the courage to admit when the initial thesis was wrong and exit the trade, preserving capital, rather than engaging in the self-deception of holding on until it comes back. LeBron's concept of discipline is deeply structural, not just motivational. It requires a trader to create a comprehensive trading plan before entering the market, the asset to be traded, the criteria for entry based on value and opportunity, the maximum risk size based on the risk principle, and the exact criteria for both profit-taking and loss-taking. The ultimate act of discipline is adherence to this plan, treating it as an inviolable contract with oneself. This process systematically removes the human element from the execution phase, ensuring that the decisions made in the cold, clear light of preparation are not overridden by the hot, chaotic emotions of real-time market action. The market is designed to exploit emotional fragility, and discipline is the only true armor against this exploitation. This is often where the difference between professional and an amateur lies. The professional knows a trade is over when the plan dictates, regardless of their hope. The amateur holds on, hoping the plan was wrong. The proliferation of crypto hype cycles and the meme stock manipulation of recent years underscore the critical failure of discipline among retail traders. In these high volatility environments, the perceived speed of potential profit often causes traders to abandon all logical constraints. They chase parabolic moves, ignoring fundamentals, and violate every rule of risk management because the social narrative, the promise of instant wealth, overrides personal caution. Discipline demands that the trader must be an island of rationality in a sea of emotional contagion. This means possessing the mental strength to sell into euphoria when the asset has reached the profit target, even if the crowd is screaming it will go higher. Conversely, it is the discipline to buy methodically during a panic when value is clear, even as the instinct is screaming to run away. The lack of transaction friction due to zero-commission trading makes discipline harder than ever, as it removes a physical barrier that once forced a trader to pause and reconsider before executing an impulsive action. Now, the friction must be entirely internal, a triumph of pre-commitment over momentary desire. Furthermore, discipline extends to the less exciting, procedural aspects of trading, such as journaling and review. The disciplined trader maintains a detailed log of every trade, the entry criteria, the emotional state, the exit, and the final outcome, to systematically identify and eliminate behavioral errors. This self-analysis is crucial because in trading, the results of an action are often delayed and probabilistic. A good trade can lose money, and a bad trade can win money. Discipline dictates that the focus must remain on the process, not the short-term outcome. If the process was executed flawlessly according to the established rules, the trader must accept the loss and move on, trusting that the positive expected value of the strategy will yield profit over the long run. If the trade was a win but violated the rules, the disciplined trader must treat it as a failure, as winning on a bad process simply trains a mind to repeat reckless behavior, a path that inevitably leads to ruin. The relentless, often boring consistency of discipline is the only path to sustainable long-term success, far removed from the sensational, high-drama narratives preferred by financial influencers. The instantaneous feedback loop of digital markets amplify greed and fear to an unprecedented degree, making the principle of discipline the most challenging law to uphold. Every financial guru, every notification, and every social media post is a direct assault on the trader's emotional equilibrium. In this context, discipline is a deliberate creation of friction. For example, a disciplined trader might impose a cooling-off period before executing a trade suggested by a sudden emotional impulse, or they might physically limit the number of times they check the market during the day, using technology as a shield rather than a trigger. The contemporary debate between passive versus hyperspeculative behavior is a direct reflection of the presence or absence of this law. The passive investor's discipline is adherence to a simple schedule, e.g., dollar cost averaging every month, regardless of price. The LeBron-style active trader's discipline is far more complex. It is a restraint to not trade when the odds aren't favorable, and the courage to take a large, calculated position only when the opportunity is maximized. For those engaged in option gambling, discipline is a strict avoidance of leveraging more than they can afford to lose, recognizing that a small, acceptable loss is a tax on a sound, repeatable strategy, while a catastrophic loss is an unforgivable failure of the self. The principle of discipline is, ultimately, the mastery of the self, which is the only true source of sustainable edge in the financial markets, a continuous battle fought not against the market, but against one's own impulsive nature. The fifth principle, the principle of time, fundamentally alters the perception of risk and reward, moving the trader's focus from the immediate daily noise to the long-term arc of market cycles. LeBron argues that time is not merely a variable in a mathematical equation. It is a critical, underappreciated dimension of opportunity and risk management. The greatest edge a disciplined trader can have is a longer time horizon than the majority of market participants. While most retail traders are fixated on the next 5 minutes or the next quarter, driven by FOMO culture and the high-frequency nature of modern screens, the true opportunity often resides in trades that play out over months or even years. This principle is a powerful counter-narrative to the prevailing instant gratification culture fueled by zero-commission trading and rapid-fire news. When commissions are free, the impulse is to trade constantly, shrinking the time horizon until the market resembles a continuous casino. LeBron highlights that the market is most inefficient at the extremes and over the longest time frames. Short-term price action is largely random noise, difficult to predict and exploit consistently. The longer the time horizon, the more likely that fundamental value will assert itself, and the more easily a disciplined trader can separate themselves from a herd of noise traders. Time allows the inevitable convergence of price and value, turning a thesis into profit. The principle of time is crucial for understanding the nature of compounding. While the short-term trader is focused on making 5% a day, a virtually impossible and destructive goal, the long-term thinker is focused on protecting capital and compounding returns over a decade. A small, consistent annual return, rigorously protected by sound risk management, will inevitably outpace the volatile, short-lived gains of the highly speculative trader. This concept is central to the ethos of the FIRE movement, financial independence, retire early, which, at its core, relies on the power of compounding over a defined time horizon. However, LeBron's lesson pushes a FIRE devotee beyond simple buy and hold. It demands that even long-term investments be timed strategically, buying when the assets are genuinely undervalued and being patient through inevitable downturns, understanding that volatility over the short term is irrelevant to the long-term goal. The compounding effect, often called the eighth wonder of the world, only truly unfolds when a trader accepts the boredom of long holding periods and refrains from tampering with sound, value-based position due to daily market chatter. This law provides necessary context for understanding massive market cycles, such as the various Bitcoin bubbles that have occurred over the past decade. A short-term trader entering near the peak of a bubble is subject to catastrophic risk when the price inevitably collapses. A trader applying the principle of time, however, would view the asset through the lens of its long-term potential technological adoption. Their entry points would be fundamentally different. They would be buying during the periods of maximum panic and disinterest, often years before the next hype cycle, comfortable in the knowledge that time is the ally of the asset's underlying value, even if the immediate price action is painful. This perspective is the essence of contrarianism, the ability to hold a strong, research position patiently while the majority of the market is either panicking or wildly euphoric. The key is recognizing the difference between cyclical volatility, which is temporary, and secular decline, which is permanent. Time allows the cyclical volatility to wash out, leaving the secular trend intact for the patient holder. Furthermore, the principle of time is the ultimate safeguard against leverage addiction. High leverage is essentially a bet that your thesis will play out immediately, as the cost of borrowing capital and the threat of margin calls increase exponentially over time. It compresses the time horizon, forcing the trader to be right instantly. LeBron's framework advocates for the use of modest or no leverage, allowing the trade sufficient time to breathe, for the market to move through its random noise, and for the fundamental catalyst to finally assert itself. The trader who is well capitalized and non-leveraged can wait for the inevitable, whereas the highly leveraged speculator is always at the mercy of clock and the daily fluctuations of the market. This law provides a deep, calming certainty. If the value is correct and the risk is managed, time will eventually reward the patience of the disciplined observer. Moreover, time is a great equalizer, allowing the individual investor, regardless of their starting capital, to exploit the institutional pressure of quarterly reporting and short-term fund performance, pressures that force large funds to often liquidate high-value assets prematurely. In the contemporary context, the dominance of ETF dominance and the narrative of passive versus active investing highlights the core tension around time. Passive investing is explicitly a bet on the long term, trusting the principle of time completely. For the active trader applying LeBron's lessons, the challenge is to find an edge that exploits the differences in time horizons. For example, a disciplined trader might exploit the short-term selling pressure caused by end-of-quarter portfolio rebalancing by institutional funds, a short-term market inefficiency driven by time constraints, to purchase a high-value asset at a discount, knowing that the selling pressure is artificial and will reverse in a matter of days or weeks. The relentless pursuit of the next viral stock promoted by financial influencers is a direct violation of the principle of time. These quick-hit promotions are designed to capture attention and capital, not to generate sustainable, long-term returns. A trader guided by LeBron will always ask, if I buy this today, am I comfortable holding for 5 years? If the answer is no, the trade is merely speculation built on fleeting hype. Time is a silent partner in all successful trading. It eliminates the noise, reveals the fundamental truth, and rewards a patient, disciplined mind over the impulsive, short-term gambler. It teaches the most profound lesson. The power of the market is not in its speed, but in its inexorable movement toward fundamental value over the long haul. The final, unifying law in Augustin LeBron's framework is the principle of simplicity. After grappling with the complex calculations of value, the detailed management of risk, the rigorous patience required for opportunity, and the emotional fortitude of discipline, the last lesson is the most liberating. Successful trading must ultimately be simple, repeatable, and easily explained. Complexity is the enemy of execution. In the financial world, excessive complexity often serves as a mask for poor understanding, an unnecessary layer of jargon, or worse, a deliberate obfuscation designed to fleece the unsophisticated. LeBron insists that the most robust and profitable strategies are those that can be distilled down to their core logic, easily understood, and executed without hesitation. This law is a necessary antidote to the overwhelming information overload that characterizes the modern market. The constant stream of data, the thousands of technical indicators, the endless variations of derivatives, and the complexity of modern financial products like synthetic ETFs or intricate option strategies can paralyze the individual trader. The principle of simplicity teaches that the complexity of the tool does not correlate with the profitability of the outcome. A simple strategy, such as buying a high-value asset when its price is significantly discounted due to a non-fundamental panic, and holding it until the panic subsides, can systematically outperform intricate strategies that rely on optimizing 30 different variables. Why? Because the simple strategy is easier to execute under pressure and less prone to behavioral errors. The cognitive load required to manage a complex strategy is a hidden risk factor. When panic strikes, the mind resorts to its simplest instincts, which usually involve abandoning the complex plan entirely. Simplicity ensures a plan is the instinct. The principle of simplicity directly confronts the culture of algorithmic trading and the rise of quant strategies that seem impossibly complex to the individual. While these high-speed, data-intensive approaches are effective for institutional firms, they provide a dangerous illusion for the retail trader. The belief that one must also develop a complex, multi-factor model to compete. LeBron's law reminds us that the best edge for the individual is often found where complexity obscures simplicity. For example, rather than building a complex model to predict the next short-term move, the simpler, more effective strategy might be to only trade assets where the supply-demand imbalance is extremely clear, or where the fundamental news catalyst is so unambiguous that the market's initial reaction is clearly an overreaction. The individual trader's advantage lies in being nimble and discerning, not in attempting to outprocess the massive servers of high-frequency firms. The advent of financial TikTok and YouTube gurus often violates this principle by promoting overly complex schemes. such as obscure option spreads or highly leveraged foreign exchange trades, that are difficult for the novice to understand and impossible to manage under stress. They add layers of complexity to create the illusion of specialized, secret knowledge. Simplicity demands that the trader should be able to articulate the exact reason for every dollar they allocate. If the strategy requires a flow chart, 5 different indicators, and 2 screens of moving averages to justify, it is likely too complex to be reliably executed when a market turns against it. The simplest truth remains the most powerful. Buy low, sell high. All the complexity in the world is merely an attempt to define low and high more accurately. But when that attempt introduces more points of failure than accuracy, it becomes a liability. The greatest traders often have the most straightforward investment thesis, which they stick to with fanatical discipline. This principle extends to the structure of the trader's portfolio itself. The rise of index funds dominating global wealth is the ultimate expression of simplicity. The acceptance that a complex market can be efficiently captured by a simple, diversified basket of assets. For the active LeBron-style trader, simplicity means ruthless pruning of the portfolio, eliminating low-conviction positions, focusing capital only on the very best opportunities, and ensuring that every asset held serves a clear, defined purpose. A portfolio of 20 high-conviction positions is fundamentally simpler, easier to monitor, and far less stressful than a portfolio of 200 low-conviction, scattered trades. The principle of simplicity is a final, mature insight of the experienced trader. That success is achieved not by maximizing complexity, but by mastering the few fundamental variables that truly matter: value, risk, opportunity, and discipline, and stripping away everything else. It is a clarity of mind that allows for optimal execution, turning chaos into a quiet, profitable routine. In the current market of robo-advisors and constant algorithmic suggestions, the principle of simplicity is more vital than ever. The modern trader faces a challenge of filtering out the noise generated by tools designed to appear sophisticated. Simplicity requires questioning every default suggestion. Why is a robo-advisor recommending this specific allocation? Is the core logic behind this complex derivative trade simple enough to manage in a panic? The rise of passive versus hyper-speculative behavior is the final battleground for simplicity. The hyper-speculator often uses complexity, such as excessive short-term trading or intricate options combinations, to satisfy an emotional need for excitement, while the simple path, the disciplined focus on a few high-quality assets bought at good value, is often rejected as being too boring. LeBron teaches that trading should be boring. It should be a simple, systematic application of defined rules. The FIRE-based asset allocation models, which rely on simple, broad diversification and regular rebalancing, are inherently aligned with this principle. For the active trader, embracing simplicity means treating trading as a systematic business process, not an emotionally charged sport, ensuring that the logic of every single transaction can be immediately understood and justified without layers of jargon or unnecessary technical indicators. This final law is the foundation of sustainable, stress-free profit. The landscape of global finance in the 2020s has undergone a tectonic shift since LeBron penned his foundational laws. The velocity of change, the accessibility of capital, and the amplification of emotional narratives have created a market that is simultaneously the most democratic and the most volatile in history. If Augustin LeBron were observing this era, what would his experience I see? How would he apply his immutable laws to a world dominated by algorithms, social media, and zero-sum speculation? His observations would not be a rejection of a new technology, but precise, dispassionate analysis of how human behavioral flaws are being amplified by it. LeBron would first recognize the profound impact of AI-driven hedge funds and algorithmic trading. He would see these quant strategies not as competitors to be feared, but as sophisticated tools that have largely eliminated short-term, low-edge opportunities. Since algorithms excel at exploiting micro-efficiencies and speed, the human trader's edge must shift to areas where the machine is still blind: long-term, fundamental value judgments, political and social risk assessment, and behavioral contrarianism. He would assert that the principle of opportunity must be redefined. The best opportunities are now found in the structural mispricings that occur over longer time horizons, or during periods of genuine panic or chaos that cause algorithms to momentarily fail or halt, where the human ability to override a system and perceive the bigger picture remains invaluable. The rise of machine learning means that any mechanical, rule-based trading system that is not proprietary will inevitably be arbitraged away by faster, cheaper technology. The human trader's only lasting edge is their capacity for nonlinear, value-based judgment, which is far harder to code. The proliferation of financial TikTok and YouTube gurus and the culture of meme stock manipulation would be viewed by LeBron as a profound challenge to the principle of discipline. These platforms monetize chaos, creating a viral loop where the narrative, the story of getting rich quick, overrides the reality of value. He would caution that the easy availability of cheap leverage through technology is the gun, and the financial gurus are selling the ammunition. This combination creates a market where prices are driven not by future discounted cash flows, but by the rapid, synchronized emotional reaction of millions of participants. LeBron would advise his students to completely isolate themselves from these noise channels, recognizing that following the crowd, especially the one assembled on social media, is the fastest path to violating the principle of risk. The ultimate act of discipline today is the deliberate, technological exclusion of the financial herd. He would also point out that the instant gratification provided by fractional shares culture diminishes the perceived risk of a trade, making it feel less like a serious commitment of capital and more like a small, harmless flutter, which quickly leads to a violation of disciplined position sizing. The rise of crypto casinos and NFT madness would be seen as the apotheosis of speculation, detached from the principle of value. While recognizing the technological innovation of blockchain, LeBron would apply a harsh, simple test. Is the current price justified by the asset's utility, or is it purely a bet on the next buyer being more optimistic? He would conclude that while some crypto assets possess demonstrable value, transaction utility, network security, the vast majority of the hyperspeculation is a behavioral phenomenon, an expression of the Robinhood generation's appetite for high-stakes gambling. The principle of risk dictates that any investment in this category must be sized as an acceptable total loss, knowing that the absence of tangible value makes the probability distribution of outcomes fundamentally negative over the long term for most projects. He would compare the NFT madness to the tulip mania of old, noting that the only difference is the speed of the narrative propagation, enabled by the digital medium. LeBron would have a nuanced view on the dichotomy between passive versus hyperspeculative behavior and the fire-based asset allocation. He would likely appreciate the wisdom of dollar-cost averaging into broad index funds dominating global wealth, viewing it as the most disciplined, simple, and time-aligned strategy for the individual who lacks a unique edge. This passive approach adheres flawlessly to the principle of simplicity and the principle of time. However, he would also note the systemic risk this dominance creates. When index funds are forced to sell, they sell everything, regardless of individual asset value, creating massive opportunities for the active, LeBron-style trader who is prepared with dry powder and a value-based buying list. The difference between the two is merely the size of the opportunity one is seeking. The passive investor seeks the market return, and the active trader seeks to exploit the behavioral and structural errors that the passive flow inevitably creates. The greatest error today is the passive investor who, having experienced a high return, mistakenly concludes they have developed an active edge, leading them to violate their own simple plan with reckless, leveraged side bets. Finally, observing the global environment of global inflation waves, LeBron would emphasize that the principle of value must now be viewed through a relative lens. In an environment where all currencies are losing purchasing power, the value of hard assets and businesses with real pricing power increases. The trading decision shifts from, is this stock going up in dollars, to is this stock preserving or growing real value. The easy availability of fractional shares culture and robo-advisors makes access simple, but it is the individual's application of the timeless laws, calmness, patience, and absolute adherence to a risk ceiling that separates the successful long-term wealth builder from the short-term, casino-driven speculator whose fate is already mathematically sealed by their own undisciplined behavior. LeBron's timeless lesson is that the new technology merely changes the speed of the game, not the fundamental rules of human psychology and economic value. Having explored the 6 powerful laws that govern successful, systematic trading, value, risk, opportunity, discipline, time, and simplicity, we arrive at the core realization that this book is not a manual for getting rich, but a masterclass in rational decision-making. The market is merely the most transparent and ruthless mirror reflecting the flaws of human psychology. Mastery of trading is the mastery of self. Here are 10 timeless principles distilled from Augustin LeBron's framework, showing how any normal person today can apply these lessons to their financial life and beyond. 1. Value over price. Never confuse the two. Price is what you pay, driven by emotion. Value is what you get, determined by fact. Before you buy anything, be it a stock, a house, or a car, you must be able to articulate its intrinsic, fundamental worth with clear, rational metrics. This principle eliminates impulsive buying driven by market chatter and provides a margin of safety necessary for all successful long-term investments. 2. Define the loss first. The primary goal of any transaction is capital preservation, not profit maximization. Always set your maximum acceptable loss before you enter a trade or investment. If the potential loss violates your risk tolerance, say 1 or 2% of your total capital, the trade is immediately invalid, no matter how good the potential upside. This systematic approach inoculates the portfolio against the catastrophic damage of leverage addiction. 3. The rule of expected value. Only engage in transactions with potential return, weighted by the probability of success, is positive. If the chances of winning are low, or the potential reward is small, the trade should be rejected. This is a simple mathematical shield against emotional gambling and the complex instrument of option gambling that often carry a negative expected value for the novice. 4. Patience as aggression, cash as a position. The greatest profits come not from constant activity, but from having the discipline and capital to act decisively when a true, high-conviction opportunity arises, marked by both mispricing and a clear catalyst. Be a sniper, not a machine gunner. Say no to 99% of the market's distractions and save your firepower for the rare, high-edge moments. 5. The power of time. Time is your strongest ally against the chaos of the short term. The longer your time horizon, the more likely you are to be rewarded for holding assets of genuine value. Ignore the daily noise. Focus on a multi-year arc, allowing the power of compounding to work its silent, profound magic, a principle understood by all long-term FIRE movement proponents. 6. Simplicity is robustness. Reject needless complexity. The most effective strategies are those that can explain clearly and execute flawlessly under pressure. If a strategy requires 5 indicators and complex math to justify, it is likely too fragile to withstand real market volatility. Embrace the boring consistency of a simple, repeatable plan that minimizes cognitive load during panic. 7. Isolate execution from emotion. Create a detailed trading or investment plan when your mind is calm. The ultimate act of discipline is a mechanical, systematic execution of that plan, refusing to let fear, greed, or the desire for revenge override the predetermined rules. Discipline is the only reliable shield against self-sabotage, especially in the high-speed environment of day trading psychology in the 2020s. 8. The process over the outcome. Never judge the quality of a decision based on a single outcome. A good process can result in a loss, and a bad process can result in a win. Focus solely on whether your rules, based on value, risk, and opportunity, were followed. This allows for continuous, rational improvement, preventing the fatal error of chasing losses or taking excessive risk after a lucky win. 9. Ignore the herd. The market is designed to exploit the collective instinct of the crowd. The greatest opportunities often emerge when you're required to take a highly uncomfortable, contrarian position. Buy when others are panicking, and selling when others are euphoric. True financial freedom requires emotional independence from the majority and the noise of financial influencers. 10. Survival is the ultimate edge. The laws of trading are ultimately the laws of survival. The trader who consistently controls their risk, manages their leverage, and protects their core capital will always outlast and outperform the speculator who chases the highest short-term return. Long-term thinking, calmness, and emotional discipline are not soft skills. They are the bedrock of financial security and the only truly sustainable edge against the chaos of the market. Any normal person today can apply these lessons to their life by simply treating their personal finances, career decisions, and major purchases as a series of disciplined, probabilistic trades. By emphasizing long-term thinking, by refusing to let social media financial panic cycles dictate their moves, and by maintaining emotional discipline, They can build a fortress of wealth that is resilient against the volatility and chaos of the modern world. The key is not to trade more, but to trade better, less frequently, with higher conviction, and with unwavering adherence to the principles of value and risk. The market is waiting to test your resolve. Let LeBron's laws be your unyielding guide. The journey through Augustin LeBron's laws of trading has brought us face to face with the true nature of financial success. It is not an esoteric secret hidden in the charts, nor is it a simple matter of luck. It is the arduous, yet profoundly rewarding process of self-mastery. We have explored the necessity of defining value amidst chaos, the existential importance of controlling risk, the aggressive patience required for identifying opportunity, the ironclad consistency of discipline, the compounding power of time, and the liberating power of simplicity. You now possess the framework used by the sharpest minds in institutional finance, a set of principles that transcend bull markets, bear markets, crypto bubbles, and meme stock frenzies. The chaotic noise of the zero-commission trading era is merely a test of your resolve, a constant invitation to abandon your plan. But armed with LeBron's laws, you're no longer a participant in the casino. You are the house, systematically imposing rational logic onto an irrational environment. The difference between enduring success and spectacular failure in the 2020s is not intelligence, but the courage to follow a simple plan when the world is screaming at you to panic. The path to financial independence is paved not with guaranteed returns, but with rigorous, honest self-assessment and the non-negotiable adherence to your rules. Embrace the discomfort of discipline, reject the temptation of instant gratification, and trust the power of time. The market will always offer the opportunity to make mistakes. Your job is simply to refuse those invitations. If you found profound value in this deep, cinematic breakdown of the laws of trading, a trader's guide to better decision-making for everyone, make sure to subscribe to Capitura, because next we're covering another classic that can completely change how you think about money and markets. Don't miss our deep dive into the next foundational text that will strengthen your resolve, deepen your understanding of behavioral economics, and secure your financial future. Hit that subscribe button and ring the notification bell so you don't miss a thing. Thank you for listening, and may your discipline always outweigh your desire for the quick win. The principle of value is not merely an accounting exercise. It is a profound philosophical stance against the tyranny of immediacy. LeBron's insistence on this first law is a battle cry against the speculative short-sightedness that dominates the modern, digitally fueled market. The confusion between price and value is the original sin of the amateur trader, and in an era where financial influencers generate hype faster than companies generate cash flow, that confusion is lethal. The price is an easily manipulated social construct, a momentary consensus driven by the most reactive, fearful, or greedy participants. Value, conversely, is an economic truth that only reveals itself over time through rigorous analysis of tangible assets, sustainable cash flows, and the quantifiable durability of a competitive advantage, often termed the economic moat. To truly understand value, the trader must become a historian and a futurist simultaneously. The historian must analyze a company's resilience through past economic cycles. How did it fare during the dot-com bust, the 2008 financial crisis, or the recent global inflation waves? Resilience, not merely growth, is the marker of true value. The futurist must then use disciplined forecasting to project future cash flows, applying a conservative discount rate that reflects the inherent risk and uncertainty. This is where the emotional element of trading must be entirely banished. The value of a high-growth tech company, for instance, cannot be based on the exponential hockey stick growth curves promoted by management or venture capitalists. Instead, the disciplined trader must stress test those assumptions, questioning the sustainability of margins and the inevitability of future competition. The higher the reliance on future and proven growth, the lower the certainty of value, and therefore, the smaller the position size dictated by the principle of risk. The catastrophic failures witnessed in the meme stock manipulation events were not failures of market efficiency, but spectacular failures of the principle of value. When a stock price detached entirely from its sales, earnings, or cash reserves, the trade ceased to be an investment in a business and became solely a bet on the continuation of narrative, a greater fool theory played out on a global stage. LeBron would dissect these phenomena as textbook examples of how FOMO culture exploits cognitive biases, specifically the anchoring bias, where a trader anchors their perception of value to the recent, euphoric high price rather than the fundamental reality. The value trader must cultivate the discipline to look past the vertical price line and see the underlying economic engine, a small, sputtering motor being asked to power an impossibly heavy vehicle of speculation. Furthermore, the complexity of modern financial products often obscures this fundamental truth. When traders engage in complex option gambling or delve into obscure derivatives, they are often attempting to bypass the rigorous work of value assessment, seeking leverage to generate profit from price movement alone. Yet, even the most sophisticated derivative strategy is underpinned by an asset whose worth is ultimately determined by its fundamental value. The successful institutional trading that LeBron experienced was not about finding secret technical indicators. It was about the rapid, systematic identification of market participants, often retail traders, who had mispriced an asset based on emotional or incomplete information. The institutional edge is simply the disciplined application of the principle of value at speed and scale. The principle of value is equally important when considering alternatives to traditional equity, especially the highly decentralized and often confusing world of crypto hype cycles. Here, value must be defined differently. It is not necessarily derived from quarterly earnings, but from a network effect, the security of the protocol, the cost efficiency of transactions, or the actual adoption rate for utility. When a coin's price surges based solely on tweets and speculation, the value trader asks, what real-world problem does this solve that justifies a trillion-dollar valuation? If the answer is none, or a vague promise of future disruption, the position must be treated purely as high-risk speculation, its sizing limited by the principle of risk to the smallest possible fraction of the total portfolio. Value, in this modern context, is the only weapon against the endless, emotionally compelling narratives that seek to separate the undisciplined trader from their capital. The recent environment of ultra-low interest rates, which facilitated cheap leverage through technology, fundamentally distorted the principle of value. When money is effectively free, the calculated discounted value of future cash flow skyrockets, allowing assets like unprofitable technology companies or aspirational growth stocks to command valuations that would have been unimaginable just a decade prior. LeBron would warn that this environment did not invalidate the principle of value. It merely created an environment where the market confused cheap capital with infinite growth potential. The value trader's job during this period was to conservatively normalize interest rate assumptions, recognizing that the current, artificially depressed rate was a temporary condition. The subsequent global inflation waves and the return of higher interest rates brutally exposed those who had violated this discipline, demonstrating that value calculated with borrowed time and borrowed money is inherently fragile. The modern lesson is clear. True value is independent of the cost of capital, and when market price relies heavily on an external, temporary factor like zero interest rates, it is an inflated, vulnerable price, not a reflection of intrinsic value. The principle of risk is the moral imperative of trading. It moves beyond mathematical calculation to encompass a deep, almost spiritual commitment to the long-term viability of one's financial existence. LeBron would argue that the amateur views risk as the chance to lose money, while the professional views risk as the chance to be taken out of the game, a catastrophic, unrecoverable drawdown that ends a career. Therefore, the principle of risk is primarily concerned with survival and anti-fragility. Survival, in trading, means maintaining a capital base sufficient to endure inevitable streaks of bad luck or temporary market insanity. The 1% or 2% rule for position sizing is not arbitrary. It is a statistical safeguard against the volatility inherent in even a positive expected value strategy. The trader must always be prepared to absorb 5, 10, or even 20 consecutive losing trades without panic or without critically impairing their ability to execute the next high-probability opportunity. The modern tendency towards leverage addiction, facilitated by easy margin and the accessibility of derivatives, violates this principle by compressing the margin for error to zero. When a small price move can liquidate an entire position, the trader is no longer a rational actor. They are a hostage to market volatility. Anti-fragility, a concept closely aligned with LeBron's thinking, means structuring portfolio so that it benefits from volatility, rather than being destroyed by it. The disciplined risk manager is not just diversifying their holdings, ETF dominance, but diversifying their risk profile. This includes allocating capital to assets that are non-correlated or even negatively correlated with the primary portfolio when stress events occur. For example, a heavy allocation to growth stocks requires a hedge against a sudden spike in interest rates or volatility, perhaps through strategic short positions or specific derivatives. Most retail traders, fueled by FOMO culture, build portfolios that are highly correlated. When one stock goes up, they all go up. When one crashes, they all crash. This is not diversification. It is illusionary safety. LeBron's law demands that the trader actively seek out the structural hedges that will generate profit during the very crises that threaten to wipe out the hyperspeculators. Furthermore, the principle of risk must encompass the risk of the unknown unknowns, the tail events that defy modeling, like pandemics, wars, or sudden liquidity freezes. The only defense against these true black swan events is to maintain a significant amount of dry powder, unallocated cash, and to never be fully invested. This unallocated capital is the ultimate expression of LeBron's discipline, as it is a capital reserved solely for the inevitable, massive opportunities that arise only during maximum panic, when the market briefly loses its collective mind and offers deep value at fire sale prices. The risk manager knows that being liquid when everyone else is forced to sell is the single greatest competitive advantage in finance. The accessibility of option gambling has also introduced a new layer of psychological risk. The defined loss characteristic of options premium often tricks the novice into oversizing their bets, thinking, "I can only lose a small premium." However, the cumulative loss from a series of high-frequency option trades can quickly eclipse any single potential stock loss. LeBron would redefine the risk here. The true risk of options for the amateur is a systemic temptation to turn trading into a high-stakes, frequent lottery, undermining the patient, probabilistic approach required for success. The principle of risk demands that one uses options not for speculation, but for controlled, precise hedging or for expressing a specific view with known, small risk, only when complexity is justified by a superior expected value. In the age of crypto casinos and decentralized finance, the principle of risk must expand to include non-traditional, systemic risks. The modern trader not only faces market risk, the price moving against them, and liquidity risk, the inability to sell, but also counterparty risk and exchange risk. The collapse of major centralized crypto exchanges and lending platforms served as a brutal, expensive reminder that if an exchange is not rigorously regulated and sufficiently capitalized, the entire capital base held there is at risk, irrespective of the quality of the underlying asset. LeBron would insist that a comprehensive risk plan today must include geographical and institutional diversification, recognizing that the custody of the asset is just as important as the asset itself. This non-market risk is ignored by almost all financial TikTok and YouTube gurus, but represents an existential threat to capital, demonstrating that the scope of risk management must now encompass technology, regulation, and solvency far beyond the traditional stock market variables. The principle of opportunity is the rigorous art of waiting for the market to make an expensive mistake. It is a realization that the trader's primary scarcity is not capital, but high-quality, high-probability trade ideas. LeBron teaches that successful trading is a statistical numbers game played only with superior odds. An opportunity is therefore the confluence of three non-negotiable elements: value, the asset is demonstrably mispriced; risk, the potential loss is strictly defined and minimal; and catalyst, a foreseeable event exists to force price correction. Without all three, the trade is merely a hopeful lottery ticket. The central challenge in the digital age is separating signal from noise. The market, amplified by social media financial panic cycles and the 24/7 nature of crypto casinos, generates infinite noise. The media, the influencers, and the daily market swings are all designed to occupy the trader's attention with low probability, low expected value distractions. The principle of opportunity is a selective blindness that allows the trader to ignore the 99% of noise and focus exclusively on the 1% of true signal. This active patience is what gives the disciplined trader their competitive edge against a majority who feel compelled to be constantly busy. Busyness in trading often correlates inversely with profit. LeBron would analyze the evolution of opportunity in the face of AI-driven hedge funds and algorithmic trading. Since quant strategies have effectively vacuumed up all instantaneous, easily quantifiable arbitrage opportunities, the human trader must seek out the behavioral and structural edges that machines cannot yet fully process. Behavioral opportunities arise when the collective human emotional reaction is so powerful that it overrides logic, such as a market-wide overreaction to a non-fundamental political event or a temporary liquidity crisis. Structural opportunities arise from market plumbing, forced selling by index funds or quarterly portfolio rebalancing pressures that momentarily depress a security's price below its true value. The key to exploiting these opportunities is recognizing that they're often uncomfortable. They require buying into fear or selling into euphoria, the exact moments when the emotional system is screaming for the trader to do the opposite. The principle of opportunity also necessitates a deep understanding of liquidity. A trade may offer immense value and low risk, but the market for that asset is thin, meaning large positions cannot be easily bought or sold without impacting the price. The opportunity is fatally flawed. This is especially true in smaller meme stocks or less established crypto tokens, where liquidity can vanish instantly during a downturn. LeBron's rule mandates that a true opportunity must be executable, meaning the size of the position must be appropriate for the depth and ease of exit of the market being traded. The amateur often seeks high returns in the liquid corners, only to find the door locked when they need to escape, transforming a calculated risk into an unmanageable catastrophe. Finally, the principle of opportunity serves as the bridge between research and action. It prevents the trader from becoming a paralyzed academic who analyzes everything but acts on nothing. The analysis of value and risk must culminate in a concrete trading plan that defines the trigger for entry and the expected time horizon, which aligns with the principle of time. A true opportunity is finite. The market error will be corrected eventually. The disciplined trader must possess a conviction and the prepared capital to act decisively when the moment arrives, knowing that hesitation turns a high-probability trade into a mischance and transforms conserved capital into wasted potential. The advent of zero-commission trading created the illusion of infinite opportunity, implying that every fractional price move is worth trading. LeBron's principle of opportunity exposes this as a mirage. The elimination of commissions lowered the economic barrier to trading, but did not lower the intellectual or psychological barrier. In fact, by making trading feel free, it encouraged excessive activity and reduced the mental diligence applied to each trade. A commission acted as a mild friction, forcing the trader to consciously justify the cost of the trade. Without that cost, the trader must impose an internal commission, a mental hurdle that requires a high expected value calculation to justify execution. The modern opportunity is not to trade everything because it's free, but to trade only the high conviction ideas, recognizing that excessive activity is the surest way to violate the principles of simplicity and discipline, slowly bleeding capital through repeated exposure to random, low-edge volatility. The principle of discipline is the ultimate defense mechanism against the self. LeBron recognizes that trading is a field of human endeavor where the primary competition is one's own impulsive psychology. Discipline is a deliberate, non-negotiable process of minimizing emotional variance and maximizing procedural consistency. It is the commitment to the unsexy, monotonous routine that allows a positive expected value strategy to manifest its statistical edge over time. Discipline begins with the creation of the pre-trade ritual. Before any capital is committed, the trader must articulate precisely why the trade is being made, value and opportunity, how much can be lost, risk, and when the trade will be terminated, regardless of profit or loss, discipline and time. This plan must be written down, creating an external contract that prevents the emotional brain from rewriting the rules in the middle of a market storm. The most common failures in day trading psychology in the 2020 stem from an abandonment of this ritual. A winning trade leads to the emotional expansion of position size, overconfidence, and a losing trade leads to a breakdown of the stop-loss order, fear, and hope. Discipline demands that every successful trade be celebrated for adherence to the process, and every losing trade be analyzed for procedural error, completely ignoring the dollar outcome. The modern market, with its hyperconnectivity and immediate feedback, is a continuous stress test of this principle. The constant barrage of information from financial TikTok and YouTube gurus, and the relentless price updates on mobile apps are direct assaults on the trader's emotional fortress. Discipline requires the creation of digital boundaries, scheduled check-ins, predetermined maximum trading hours, and a ruthless rejection of external noise. When the entire internet is screaming about the next meme stock or crypto hype cycle, the disciplined trader must cultivate the habit of silence, trusting the calculated value over the social narrative. The courage to be alone in one's conviction is a hallmark of professional discipline. Furthermore, discipline extends to the management of leverage. The excessive use of cheap leverage through technology is a psychological trap because it allows the trader to feel rich and powerful quickly. However, this feeling is a temporary delusion. Discipline mandates that leverage must only be used if it enhances the probabilistic expected value of a trade without exposing the core capital to existential risk. If the leverage forces a compressed time horizon, demanding instantaneous success, it violates the principles of risk and time and should be rejected. The ultimate act of discipline is recognizing that true wealth is built slowly, systematically, and boringly through the rigorous accumulation of small, consistent, risk-managed gains. The deepest layer of discipline is a commitment to journaling and review. LeBron would stress that this is not merely an accounting task. It is psychological surveillance. By meticulously recording the emotional state before, during, and after a trade, the trader begins to identify their personal behavioral biases, when they are most likely to overbet, when they are most likely to panic, and which narratives trigger their FOMO. This process weaponizes self-awareness, allowing the trader to preemptively manage their own flaws. If a trader finds they always abandon their stop-loss when the market drops rapidly, the disciplined solution is to make the stop-loss order mechanical and non-cancelable, outsourcing the emotional decision to the technology itself. The widespread adoption of passive versus hyper-speculative behavior has created two extremes of discipline. For the passive investor relying on dollar-cost averaging DCA and ETF dominance, the discipline is a simple, relentless act of automatization, setting up recurring investments and ignoring the market. The moment a passive investor starts checking their portfolio daily, worrying about dips or trying to time their monthly DCA contribution, they introduce behavioral slippage, violating the core principle of discipline. For the active LeBron-style trader, the discipline is far more complex, requiring active resistance to the temptation of high-frequency trading. The ultimate modern test of discipline is the ability to maintain a high cash position, dry powder, for months or years, patiently waiting for a true opportunity, resisting the constant urge to deploy capital into mediocre ideas just for the sake of feeling productive. The principle of time is a gravitational constant of finance, the force that ensures that fundamental value, however obscured by short-term noise, will eventually assert itself. LeBron views time not as an obstacle, but as a filter that separates the noise traders from the value investors. The disciplined trader operates with a time horizon that is fundamentally longer than the vast majority of market participants, providing them with profound, non-quantifiable competitive advantage. The speed of the modern market, accelerated by zero-commission trading and 24/7 global access, shrinks the perceived time horizon for almost everyone. This short-term focus creates opportunities for the long-term thinker. When a stock drops sharply on temporary news, a poor quarterly guidance that is not fundamentally destructive. For example, the short-term, emotionally driven market sells indiscriminately. The value trader applying the principle of time knows that the market's overreaction is temporary and that the long-term cash flow profile remains intact. Time gives the trader the luxury of patience, the ability to wait for the volatility to settle, and the certainty that the price will ultimately converge with the real value. The exponential power of compounding is the most direct reward of this principle. Compounding requires three things: high returns, low fees, and most importantly, time. The trader who is constantly trading, paying taxes on short-term gains, and incurring trading costs, even zero commissions hide spread costs, constantly interrupts the compounding process. LeBron's law advocates for a strategy where high-conviction trades are allowed to mature over multiple years, maximizing tax efficiency and allowing the geometric growth of capital to take hold. This strategy is a financial core of the FIRE movement, which understands that achieving financial independence is a race against time, where the goal is maximizing the duration of compounding, not the volatility of daily returns. The The principle of time also provides the necessary context for understanding and enduring drawdowns. Every asset, even the highest value, will experience significant periods of decline. The amateur sees a drawdown as a catastrophic failure and often sells at the bottom, locking in a permanent loss. The disciplined trader, armed with the principle of value, sees the drawdown as a temporary market inefficiency, a failure of price, not a failure of value. Time becomes a healer, allowing the trader to ride to the panic, knowing that the structural value will eventually reemerge. This patience requires profound emotional discipline and the absolute rejection of the fear broadcast through social media financial panic cycles. Furthermore, time is the crucial differentiator between speculation and investment. Speculation is a bet that the market will immediately agree with your thesis. Investment is a bet that the underlying economic engine will produce value over time, regardless of short-term price fluctuations. When a trader uses excessive leverage addiction, they are effectively reducing their time horizon to zero, making a speculative bet that must be right now. LeBron would argue that the use of leverage is fundamentally a violation of the principle of time, as it removes the trader's most valuable asset, the ability to wait, and subjects them to the instantaneous whims of the market. The modern market has created the velocity of obsession, where every participant is encouraged to be obsessed with the immediate price movement. The accessibility of fractional shares culture and robo-advisors means that everyone is constantly connected to their money. The principle of time demands that the trader actively slow down their internal clock. This may mean moving from hourly checks to weekly checks, or even quarterly checks for long-term positions. For the active trader, it means focusing analysis only on the weekly or monthly charts, ignoring the minute-by-minute fluctuations that lead to emotional mistakes. By consciously extending their time horizon, the disciplined trader exploits the short-term hysteria of the majority, buying into dips created by panicked, short-sighted selling, and selling into peaks created by euphoric, short-sighted buying. Time is a silent, guaranteed edge for the patient, and in the high-speed world of the 2020s, it is the most countercultural and profitable discipline one can possess. The principle of simplicity is the final layer of protection, guarding the trader against self-inflicted confusion and paralysis. LeBron's core tenet is that complexity is a magnet for error, while simplicity ensures replicability and execution under duress. True intelligence in finance is not demonstrated by the ability to manage complex models, but by the ability to distill complexity into a clear, actionable, and repeatable strategy. In the institutional world, complexity is often a necessity for managing billions across multiple asset classes and regulatory frameworks. However, for the individual trader, try to emulate the intricate quant strategies or adopting overly sophisticated technical analysis, layers of moving averages, oscillators, and esoteric chart patterns, is self-defeating. The principle of simplicity teaches the trader to ask, if I lose power or if the market crashes and I have 5 seconds to decide, can I articulate my plan based on core information? If the answer requires consulting a secondary monitor or referencing a multivariable model, the strategy is too complex. The simplicity LeBron advocates is built upon the foundation of the other 5 laws. A simple strategy is one that 1. Only trades when value is obvious. 2. Uses a fixed, small risk percentage. 3. Waits patiently for a clear opportunity and catalyst. 4. Is executed with mechanical discipline. And 5. Is aligned with a long time horizon. This creates a powerful, integrated framework that requires no extraneous indicators. The market price itself, when compared to calculated intrinsic value, is the only indicator truly needed. The noise generated by financial TikTok and YouTube gurus thrives on complexity because it makes the novice feel like they are receiving secret, specialized knowledge. They promote complex, low probability, high fee products or trading strategies that are inherently fragile. The disciplined trader applies the principle of simplicity by rejecting anything that cannot be immediately understood or that relies on opaque or proprietary metrics. The simplest investment strategy, dollar cost averaging into a diversified portfolio of ETF dominance, is often the most profitable precisely because it eliminates the vast majority of behavioral errors and ensures long-term exposure to global economic growth. The active trader's job is to apply an equivalent level of simplicity to their decision-making process. Simplicity also demands honesty about the trader's own capabilities. A trader who is not an expert in biotechnology should not trade biotech stocks, regardless of how attractive the FOMO may be. The principle of simplicity dictates that the trader must remain within their circle of competence, trading only assets, industries, or strategies they fundamentally understand. Trading outside the circle introduces unquantifiable risk and complexity, violating the laws of both value and risk. The vast majority of trading mistakes are not errors in complex calculation, but simple human errors rooted in overconfidence, emotional fatigue, or unnecessary complexity. Simplicity is the final, mature act of intellectual honesty, recognizing that less is often, emphatically, more. The accessibility of fractional shares culture is superficially simple. It allows small dollar amounts to buy slivers of expensive stocks. However, this seemingly democratic tool introduces a subtle complexity when it leads to portfolio fragmentation. The disciplined trader must use the principle of simplicity to avoid holding 50 small, fractional, low-conviction positions across various sectors, simply because the entry barrier is low. Simplicity dictates that the capital must be consolidated into a few high-conviction opportunities, where the due diligence is manageable and the impact of each position on the overall portfolio is significant enough to warrant the attention and risk. The ease of buying fractional shares must not lead to a complex, unmanageable mess of low-conviction speculation.